All right. I think that we are going to get started with this webinar. We see people rapidly joining on the hour. Welcome everyone to this webinar event on advancements in nature-related risk and climate-nature integrated scenarios for financial decision making. A very happy Thanksgiving to those who celebrate today. My name is Julie McCarthy. I am the CEO of NatureFinance, which, for those who don't know, is a nonprofit organization that works to align finance with an economy that works for nature, climate, and people. We are delighted to be co-hosting this event today with the European Central Bank and the Potsdam Institute for Climate Impact Research, and to be joined by such an impressive suite of panelists and an audience that I understand is made up of a really diverse range of stakeholders, from central bank and financial supervision representatives to policymakers and financial institutions to donors and civil society organizations. As many of you may know, NatureFinance recently partnered with the ECB and PIC on one of the key pieces of work we'll be discussing today, which is a first attempt to develop integrated climate nature scenarios for assessing economic and financial risk for central banks. That research is just one of a broader set of really important developments over the past 2 years that are aimed at helping central banks and financial supervisors draw on the latest scientific research, monitoring technologies, economic modeling approaches, to better anticipate and hopefully help prevent the increasingly serious and complex threats to financial stability that are posed by the climate and nature crises. So we're really thrilled to be able to share and discuss some of those cutting edge efforts with everyone today. In the spirit of American Thanksgiving, I just want to give thanks up front to all of the panelists here for their pioneering work in this domain, and in particular, the ECB for acting as a kind of lighthouse amongst central banks on this issue of integrating climate and nature risk. And through your leadership here, helping us all begin to reckon with what kinds of tools, research, and policies are needed to help central banks, financial supervisors, and ultimately financial institutions and policymakers better understand how to protect financial stability and mitigate risks in the context of a rapidly intensifying climate and nature crisis. So with that scene setting, let me do a very quick review of the run of show today and then get us started with our very full program. So we have a two-part program today. The first hour, we're going to spend diving into recent research and its implications for specific context and financial supervision in Europe. And the second hour, we're going to have an interactive panel discussion looking at the future of this field. We're going to kick off in a second here with remarks from Frank Elderson, who's a member of the executive board and vice chair of the supervisory board of the ECB. We're then going to hear from Marguerite O'Connell, who's legal counsel in the ECB's financial law division, about key insights from a recent ECB working paper on nature-related risks and biodiversity loss. We'll then hear from Miodrag Stevanovic, a senior scientist at PIC, who's going to present the results of this recent nature climate integrated risk scenarios work that they did in partnership with the ECB and NatureFinance, which is focused specifically on the European agricultural sector. This will be followed by a presentation by Kata Molnar, who's a senior analyst at the Hungarian National Bank, about a recent study that they did in partnership with the OECD on nature-related financial risks in the Hungarian financial system. And then finally, we will hear from Dr. Nicola Ranger, who's director of the Global Finance and Economy Group at Oxford, who's going to share insights from recent work that they've done on nature-related financial risks in the UK. After each of these presentations, time allowing, we're going to try and take one or two questions from the audience before moving on to the next one. So please feel free to put questions in the chat as we go along, and my colleagues will be collecting them and sharing them with me. At the end of the hour, we're going to take a quick break, 5 to 10 minutes, and then come back for an interactive panel that I'm going to moderate, where we look forward to what kinds of research tools and policy interventions are needed to best equip central banks and financial supervisors to address nature and climate risk. That panel will include Irene Hemskirk of the ECB, Sjord Vanderswag of DNB, Alexander Barkawi of CEP, Alexander Pop of PIC, and Justin Johnson of the University of Minnesota, who is also waking up very early on Thanksgiving to join us today. So thanks to him. I will close us out around 4 o'clock Central European time. And with that, I'm going to hand over to Frank for some welcoming and framing remarks. Thank you very much.
Well, thank you so much, Julie. I was, um, really looking forward to this session today. I think it is of great importance. Actually, I would like to call it, it's of vital importance, using the word vital, intentionally. The global economy and finance need nature to survive. A thriving natural environment provides many benefits that sustain human well being and the global economy. Think of fertile soils, pollination, timber, fishing stocks, clean water, clean air. Unfortunately, intensive land use, climate change, pollution, overexploitation, and other human pressures are rapidly and seriously damaging our nature. As is the case with the climate crisis, nature degradation affects companies and banks via two main channels: physical risks and transition risks. Physical risks may be acute risks, such as increasingly severe natural disasters, or chronic risks, such as dwindling ecosystems. And the effects could include falling crop yields owing to a decline in pollination, or by declining pollinating insect populations, or the degradation of agricultural land. The scarcity of natural products could lead to supply side shocks for the pharmaceutical industry, or make some tourist destinations less attractive. If the climate crisis and nature degradation continue unchecked, we will face rising macroeconomic instability as climate related and ecosystem disruptions become more frequent and more severe. On the other hand, transitioning successfully to a green, sustainable economy will demand substantial investments, fundamentally reshaping the way our economies operate. Now, elected governments are in the lead and have the most powerful tools to prevent the destruction of nature, as they are the ones who make environmental policies. Yet, we, as central bank and supervisors, we need to take nature related risk into account in the pursuit of our mandate, just as we do with any other factors that are vitally important to price stability and the safety and soundness of banks. As I had outlined just a few weeks ago at the Euro Finance Week here in Frankfurt, if we want to advance climate and nature work in the central bank world, we need a link between economics and science. And today's event and the wonderful report published last week by the NatureFinance, ECB, and Potsdam Institute for Climate Impact Research and the University of Minnesota is one excellent, and I don't say that easily, one excellent example of cross-sector collaboration and a testament how science and economy can advance together. Together, they have partnered to advance pioneering efforts to develop a novel integrated climate nature scenario framework, combining macroeconomic and biophysical models. My colleagues later in this session will elaborate on the insights during, over what is it, the next 1.5, 2 hours. So why is this work so vitally important? An integrated approach to climate and nature is critical because the effects are interconnected and amplify the physical and transition risks. When climate and nature related risks are examined together, we gain a far deeper and a far more and a far more comprehensive understanding of both economic and financial risks. It is therefore imperative that forward-looking risk assessments adopt an integrated approach encompassing both climate and nature-related aspects in order not to underestimate financial stability risks. The work presented today is an important step to improve our comprehensive understanding of these integrated climate and nature-related economic and financial risks through scenario development. Given the high level of uncertainty regarding impacts, non-linearities, tipping points, and irreversibility, coaching nature and climate-related risks separately is already complex. An integrated approach is even more so. Scientific input is therefore needed to deepen understanding of the transmission channels to our economies. More work needs to be done, and we as central banks and supervisors can certainly not do that alone. So I would like to deeply thank NatureFinance and the ECB colleagues for jointly organizing this event and bringing people together to share and discuss insights of work done so far and identify next steps to set. I wish all of you a very inspiring event.
Thank you so much, Frank. My video is not available right now, it seems, but I just want to say that was a really sobering and inspiring call to arms around nature climate integration and risk assessment, and more broadly, the integration of science and economics for all of us to frame this conversation. So with that, I'm going to turn immediately to our first presenter, Marguerite, who's going to talk to us about a recent working paper around nature-related risks and biodiversity loss and the legal implications for the ECB. So over to you, Marguerite.
Many thanks, Julie, and many thanks for the opportunity to present this legal working paper, which was published in June of this year. And I should add that while it is an ECB legal working paper, the usual disclaimer applies to my remarks. So if we could turn to the overview slide. What I will do today is, following a brief introduction, I will give an outline of some of the international agreements and EU legislation on nature, before giving you an overview of the key findings of the paper regarding how nature may be relevant to the ECB's monetary policy mandate, and then how nature is already being considered in the context of the ECB's banking supervision, before saying a few words of conclusion and of outlook. So turning now to the introduction, I think it suffices to say that there's increasing recognition of just how relevant nature-related financial risk is for the work of central banks and supervisors. This is due to its potential significant macroeconomic implications, its implications for financial stability, and for the microprudential supervision of credit institutions and of financial institutions more generally. This is all very clearly explained and outlined in many recent documents, and particularly the NGFS Conceptual Framework on Nature, published in July of this year, is very helpful in this regard. What is interesting here is to think about what are then the legal implications for central banks and supervisors in carrying out their mandates. And there, I think it might be worth emphasizing, as Mr. Elderson already did, that the primary and most effective actors to take action to tackle nature degradation and the nature crisis are governments and legislators. Central banks and supervisors can only take action insofar as it fits within their statutory mandates. And that perhaps brings us to a good point where we can have a quick look at what is happening both at international and EU level in terms of the policies being agreed and adopted by governments and legislators. So, next slide, please. So at the international level, we have, of course, had a number of international agreements in place for many decades, but it wasn't until the early 90s that we saw a more holistic approach being taken at global level to protect biodiversity and nature, with the 1992 Convention on Biological Diversity. More recently, in 2022, we saw the Kunming-Montreal Global Biodiversity Framework being agreed by 196 state parties, including the EU. Now, while some have dubbed this the Paris Agreement for Nature, it is not in fact a separate new international agreement. Rather, it is a strategic plan or a strategic framework to better implement the existing Convention on Biological Diversity by setting out goals and targets in order to help protect and restore ecosystems. Turning to the next slide, at EU level, we have also had significant legislation on nature in place for many decades, but it's helpful to note that we did see quite a considerable push by the EU under the last Commission to adopt further legislation to address the nature crisis. This includes, of course, the Nature Restoration Law, which places obligations on EU member states to put in place effective and area-based restoration measures to protect the Union's land and sea areas, and various legislation on global supply chains of corporates, especially the Deforestation Regulation and the Corporate Sustainability Due Diligence Directive. Turning to the next slide, we can also see that the EU's sustainable finance framework also very much anticipated and took into account the need to include provisions regarding not only climate, but also nature. In particular, the Corporate Sustainability Reporting Directive includes a number of disclosure standards that are very relevant to nature and biodiversity, including on pollution, on water and marine resources, and on biodiversity and ecosystems. Once the first reporting under that directive comes available from the beginning of next year, we can hope to get a much better understanding of companies' materials, risks and opportunities arising from nature, along with their impacts and dependencies on nature. Of course, the CSRD has some drawbacks in terms of the fact that some disclosure standards are subject to materiality assessment, while others are voluntary. But nevertheless, the availability of this data is very crucial for policymakers across the EU, including central banks and supervisors. Other elements of the EU Sustainable Finance Framework have also taken into account the need to support investment being channeled towards environmental objectives, not just climate, but also nature-related objectives. So turning then to how the next slide on how nature might be considered relevant to the ECB's monetary policy mandate. So the paper looked at this from through three angles. First, it looked at it from the perspective of the ECB's primary objective of maintaining price stability. And it included that indeed action by the ECB may be necessary where and when it is established that nature-related risks can have macroeconomic consequences with an impact on price stability, and or where it may have financial risks, which may have significant negative impacts on the Eurosystem's balance sheet, in particular due to the fact that the Eurosystem holds corporate bonds. There also, it was emphasised that, as Mr. Alderson said in his introduction, that an integrated approach is essential to capture the cascading effects of nature degradation and climate change on the real economy and on financial stability. The second key point mentioned in the paper was to examine how nature might be relevant to the ECB's secondary objective. As you know, the ECB has a secondary objective which states that without prejudice to price stability, the ECB shall support the general economic policies in the Union with a view to achieving the objectives of the Union. These objectives include the sustainable development of Europe and a high level of protection of the environment. With regard to the secondary objective, the paper concluded that at the current juncture, it's a little less clear that nature protection constitutes an independent general economic policy in and of itself. This is because, by contrast to the EU's climate policies, it's not so clearly linked to the economy so far, these nature policies. In the field of climate, we of course have the Paris Agreement, but also of course the European Climate Law, the Fit for 55 package, and a whole host of other measures that make clear that all economic sectors will be affected and must adapt to net zero. However, the fact that nature protection is not yet a general economic policy in and of itself does not mean that we can simply ignore it with reference to the ECB's secondary objective. On the contrary, we have to take into account that where nature protection is directly contributing to climate mitigation, it can be considered an aspect of that general economic policy which the ECB must support. Second, of course, we need to continue monitoring EU policies and EU law developments in this area, especially as further measures may be taken to implement the Kunming-Montreal Global Biodiversity Framework. And finally, and this leads me to the third point addressed in the paper, this will not release the ECB from its other treaty-based obligations to consider environmental protection requirements. These are set out in certain transversal principles of the treaties, and by that I mean specifically Articles 11 and 7 of the TFEU. Article 11 TFEU states that environmental protection requirements must be integrated into the definition and implementation of the Union's policies and activities. And these, of course, include the Union's monetary policy. Article 7 TFEU states that the Union shall ensure consistency between its policies and activities, taking all of its objectives into account. This implies that Articles 11 and 7 TFU not only require the ECB to refrain from adopting policies that might counter the Union's policies to protect nature, but indeed should positively oblige the ECB without prejudice to price stability to positively consider nature in the design of its policies. Now, what this might concretely mean in terms of policy actions it's a bit too early to say, but I will say a few short words in the conclusion and the outlook. Turning now to the next slide regarding how nature is already being incorporated into the ECB's banking supervision. There, nature degradation is already treated as a component of physical risk and indeed is considered a risk driver of all the traditional types of prudential risk. This was already recognised back in 2020 with the ECB's guide setting out supervisory expectations for climate and environmental risk management, where the loss of ecosystem services was already included as a risk that banks would need to address. Likewise, in the more recent 2022 thematic review, which conducted a deep dive into climate and environmental risk strategies, governance and management, the ECB identified a number of good practices being undertaken by banks, which were helping them to meet the supervisory expectations put in place by the ECB on environmental risk. And indeed, the ECB will continue to supervise these banks and look into whether these supervisory expectations are being met going forward. So turning now to a few words of conclusion. The key findings of the paper were that nature-related risk indeed has legal implications for the ECB, and their macroeconomic research and assessment will be crucial. And that's why the presentations today, the research being published today is so helpful. And it's why the research was flagged as a key component of the ECB's climate and nature plan for 2024 and 2025. Of course, here, improved data availability and improved quality of data would be very important to enable the ECB and other policymakers to better identify and address the relevance of nature for their activities. In terms of future action, while it's a bit too early to say what exactly should be undertaken, it's helpful to already look at what some central banks are already doing within the EU. For example, we see the Banque de France, it already has a corporate biodiversity footprint methodology for its own funds and pension liabilities portfolios. The Netherlands Bank has done considerable work on the topic, including a case study on nature risks in its own account investments. And the Hungarian Central Bank has also done considerable work in the field and had in place, for example, a green mortgage bond purchase programme, which took into account environmental factors, along with its supervisory work in the field, which we'll hear about shortly. So to be very short, not only does the ECB's legal framework facilitate and support integrating nature considerations into the ECB's work, it also requires the ECB to give proper consideration to these risks going forward. Many thanks for your attention.
Thank you so much, Marguerite. That was a really helpful grounding in where nature and climate fit into the ECB's monetary policy mandate right now. And related legislative developments in the EU. So I'm gonna shift us, just in the interest of time, next to Miodrag. I'm gonna ask that for all of these presentations, we actually just continue to collect questions in the chat. And then at the end of this first session, hopefully we'll be able to come back and ask a few of the panelists. But for now, let's move on to Miodrag.
Thank you, Julie. Good day to everyone. I'm going to present you with the outcomes of our pilot project on climate nature risk scenarios, which we did, as it was mentioned, together with our colleagues from NatureFinance, European Central Bank, and the University of Minnesota. The central question that we sought to answer was whether integrating climate and nature-related risk into scenario analysis would yield a materially different assessment of these risks, but we also wanted to expose research needs and potentially knowledge gaps to have a more complete climate nature risk framework in the future. And next slide, please. On to climate nature risk scenario framework. By integrating climate and nature policies and ambitions in different combinations within scenario narratives, this framework simulates potential transitions to achieve specific targets. Here we are spanning the scenarios across two dimensions on nature and climate, resulting in 4 different scenarios: degraded world scenario with lack of any protection of climate and nature, moving to two silo scenarios, disorderly scenario that only focuses on climate change mitigation, and managed ecosystem that only considers nature protection ambition. And lastly, the nexus approach where we integrate climate and nature in one scenario. The scenarios have global and EU focus, and they are in line with the NGFS climate risk scenarios. We simulate different policies for mitigation, for example, in line with the Paris Agreement, but also some future potential policies for the agricultural and land use sector. And also we simulate a few different nature conservation targets as, for example, the mentioned one from the Global Biodiversity Framework, Kunming, Montreal, 30 by 30 nature conservation. Next slide, please. The central model in the assessment is the land and water use model MAGPIE, which stands for Model of Agricultural Production and its impact on the environment, where scenario building blocks are individually modeled as policy instruments or policy outcomes. But to capture the future impacts of climate change in the land use sector, our modeling framework expands beyond the MAGPIE model by including future biophysical simulations of crop yields and water availability, for example, from the dynamic global vegetation crop and hydrology model, LPJML, which is then driven by GCM climate models, meaning different future temperature and the precipitation pathways. And further to derive ecosystem services and access to environmental degradation, MAGPIE is linked in the post-processing to the SEALS model from the University of Minnesota, which allocates projected land cover changes from MAGPIE at the resolution of 300 by 300 meters, where actually it matters for ecosystem service assessments. And we focus on three indicators here: pollination sufficiencies, area of habitat for endangered species, and soil erosion. Next, please. Jumping into results. Here, starting with the physical risks, the graph shows cropland landscape biodiversity intactness index and how it develops in the projected scenarios until 2050. The main outcome here is that an integrated approach to climate change scenarios provides a more nuanced and comprehensive understanding of biodiversity loss risks compared to the silo scenarios. If we look in the red line, which is degraded world, we see that the degradation of nature further intensifies the decline in biodiversity in these scenarios, but more notably, that disorderly scenario with climate policy alone does not necessarily lead to biodiversity protection. Next, please. Staying on physical risk level for the nature contribution to people indicators, this figure shows on the left side the status of pollination on a spatial level globally in 2020 from the areas with low to high sufficiency of pollinators. And our analysis shows that conservation interventions significantly restore pollination supply, which you can see on the right-hand side in the projections for 2050, but where nature protection scenarios, the last two here, restore quite a lot of areas of low pollination sufficiencies to high pollination sufficiencies level. Next slide, please. On the transition risks, here I'm showing an example of the price index for agricultural commodities and how it develops over time, over simulated time until mid of the century for different scenarios. Notably, the highest levels of the price increase are reached in the disorderly scenario. So the climate policy has here the strongest impact on the agricultural price index. The main driver behind this is an increase, because this increase is the direct pricing of greenhouse gas emissions in the agricultural sector. However, if we integrate nature also with the climate mitigation policies in the green trajectory, we see that the costs are significantly buffered, and consequently the prices as marginal costs are reduced. Next, please. Potential implications of these results in the next 4 slides across scenarios. We see that the biophysical risks associated with the degraded scenario include an assumed global mean temperature increase up to 4 degrees by the end of the century, alongside globally unsustainable land use practices. These conditions are expected to drive significant biodiversity loss, as we've seen, and the further degradation of critical ecosystem services, such as soil erosion and pollination supply in our analysis. For the EU, the total cropland is, however, projected to remain constant until 2050. However, this stability masks potentially underlying vulnerabilities, as high soil erosion rates could result that are resulting from land swapping, and climate change can potentially lead to degradation of agricultural land in Europe. On the economic side, initially economic risks appear lower, with stable agricultural costs providing short-term economic stability, both globally in the EU. However, the long-term economic impacts of ecosystem degradation and climate change could pose actually significant financial consequences, which the current modeling framework does not fully capture. Next, please. On the climate protection only policy scenario, under the disorderly scenario, global mean temperature is projected to be mitigated under 2 degrees. Globally, natural vegetation, basically non-forest areas, are reduced under these scenarios, and biodiversity remains insufficiently safeguarded, as I've showed. In contrast, at the EU level, vegetation is largely protected, leading to reduced cropland expansion, which is helping to mitigate some risks. As a result, selected ecosystem services in the EU are less at risk compared to global trends. Economically, both globally and within the EU, the agricultural sector faces considerable transition risks under the disorderly scenario. Mitigation policies drive up agricultural prices, creating additional financial pressures. And the sector will require substantial investments in agricultural improvements, such as enhanced productivity of land and sustainable land management practices. Next, please. Nature protection only scenario. Under this scenario, climate change is expected to lead to approximately 2.6 increase of temperature by the end of the century. It sets ambitious nature conservation goals, as I mentioned, but these measures improve global forest cover and install critical pollination services essential for agriculture. Within the EU, though, these conservation efforts are expected to result in a substantial increase in biodiversity, highlighting the positive impact of targeted environmental policies. Economically, globally, the transition to nature protection policies results in a moderate increase in agricultural costs. But in the EU, because of somewhat stricter nature protection measures, these investment costs might be amplified. Next, please. Finally, the integrated approach of climate and nature assumed global mean temperature increase is to around 2 degrees by the end of the century. This scenario emphasizes the preservation of existing habitats and safeguarding biodiversity throughout, through reduced agricultural expansion in both global and EU context. Globally, it also promotes new forest creation, contributing to ecosystem restoration. However, there are trade-offs across ecosystem services, such as increased soil erosion, what we saw in our results in vulnerable areas, despite better restoration of pollination services compared to the disorderly scenario. Economically, while economic risks persist, they are less pronounced than in scenarios with siloed policies. And by integrating climate and nature measures, this scenario enables long-term economic stability, preserving biodiversity and also at the same time mitigating climate change impacts. Next, please. On the lessons we learned through this project, there are of course many, but I highlighted a couple of them. The overall risks may have been underestimated, particularly due to missing feedback channels that we model, such as the impact of nature degradation on crop yields, and that has serious consequences on the results in the degraded world scenario. There is a need to improve the representation of near-term shocks, especially in the effects of extreme weather events. Increased spatial granularity, potentially down to the country level, would better facilitate the assessment of risks. And a general equilibrium approach might be necessary to fully capture the broader economic scope of risks, such as supply chains across sectors and their overall economic effects on GDP. Lastly, assessing risks in the EU financial sector remains challenging here due to both one sector, agriculture sector focused approach, and also lower exposure of EU markets to nature degradation. Just to conclude with one sentence, hopefully this information for assessing future changes, economic and biophysical risks would be aiding the design of appropriate and effective policy for protecting nature and climate. Thank you very much.
Thank you so much, Friedrich. There's so much in there to get through, and we have some questions in the chat, which people should feel free to actually start answering in the chat, just in the interest of time, so that we can stay within boundaries here. And we're going to move to the next presentation from Kata Molnar from the Hungarian National Bank. So over to you, Kata.
Thank you, Julie, and hello, everyone. I'm very happy to be here with you today to present the supervisory framework for assessing nature-related financial risks and its application to the Hungarian financial sector. So I'll dive in immediately. Next slide, please. So a research project was initiated by us, the Hungarian Central Bank, and received funding from the European Commission. And through a collaboration of data sharing and analysis, OECD led the project implementation. Over the course of approximately 2 years, we produced 3 key outputs. The first one being mapping existing tools and metrics on nature-related financial risk. The second being developing a conceptual supervisory framework on how supervisors and, more generally, banks can assess risks stemming from nature. And then the third, how to implement this. And we tested it on the Hungarian economic system. And as a last step, basically, we spread the outcomes through a knowledge share. All these materials are available online, downloadable. And next slide, please. I'm just going to quickly show you the framework because the key objective of the research was to enable financial authorities to identify, conceptualize, and assess nature-related financial risks through 4 steps, basically. The first is identifying risks and prioritizing them through looking into financial assets, loans outstanding, materiality, through assessing how economic activities are linked to different ecosystems and how they impact and depend on nature. From there, we did an economic assessment, a financial risk assessment, and a supervisory considerations. And so I will do my best and try to do justice to go through the key findings of all these 4 steps, basically, in my presentation. So turning into the risk identification and prioritization, basically within this, the first step was understanding impacts and dependencies and how they relate to transition and physical risks. And what we found is that transition risks stem from sectors significantly contributing, as you can see on top of the list, GHG emissions. On the physical risk side, those risks stem from sectors heavily dependent on water, mostly water, including surface water, groundwater, and some other water-related ecosystem services. So what we found is that out of the total corporate lending by Hungarian banks to non-financial corporates, the project found that there is a great exposure of the Hungarian banking system to transition risks over physical risks. And this is due to the larger proportion of lending associated with industries that impact ecosystem services compared to those that depend on them. On the next slide, this chart is really a snapshot of direct dependencies. We have a similar one produced on impacts. This is just one example of the loans and debt instruments using Hungarian banking data. And we also use ANCOR, and its definitions of ecosystem services. So this chart shows you the distribution of the total portfolio amount across industries and the impacted drivers that were assessed based on ANCOR standard maturity scores. So for example, the purple, if you can see, I don't know how much you can see the color codes there, but the purple lines, for example, display here the links of transportation and storage activities, dependence on multiple ecosystem services with mass stabilization and erosion control, biomediation at the higher maturity of dependence. So these charts were generated through the software code that was developed for the project, which is also accessible actually online and can be used for similar assessments. On the next slide, we tried to include a geographic location assessment as well. It is key for these types of assessments, as you know. However, our research unfortunately also did not have asset level data, so findings remain at the higher, yet as you can see on these maps, still it's a subnational level at least. So our findings at the very high level show that manufacturing, agriculture, forestry, fishing, mining, construction, so very not surprising sectors are most directly linked to impacting nature and being dependent on its services. So these are the sectors that we found being most critical, also from a value chain perspective. And we could also sort of identify the areas within Hungary to have higher exposure levels. Moving on to the second step, which is the economic risk assessment. Before you start looking into the charts, let me just add a bit of background to the domestic case study, because we explored the economic impact of a severe drought in Hungary under 3 scenarios, different lengths of shutdown periods to 1, 2, or 4 months. This was applied at the ecosystem level, affecting the flow of water-related ecosystem services. And we've identified 3 drivers to contribute towards future drought-related risk in Hungary, which are demands on water extraction, climate change, and loss of natural land cover. So with that, we did the economic risk assessment, and the analysis describes really the potential impact on GDP, sector output, trade, relative cost, inflationary pressures from the drought scenarios. So the first chart shows agri-commodities price changes, and the second shows results for sector output reduction. And what we can see is that overall GDP under these severe scenarios could be reduced between 3.8 to 7.1%. The total volume of output in crop production decreases by 25% due to these extreme weather potential scenarios. Most affected agriculture commodities relative price changes could be between approximately 30 to 60%. And the shock is primarily contained in the manufacturing, agri-forestry, and fishing sectors, as again I said, not very surprisingly. Moving on to the financial risk assessment, we use the results of this economic risk assessment under these 3 scenarios and fed it into the financial risk assessment to see the credit and market risks, and also to see the financial system interactions with the real economy feedback. So our findings under these water stress tests is on credit risks show that non-performing loans in the banking system could increase and primary sectors are affected. On the market risk side, we found that Hungary could expect sovereign debt increase, nearly 80% of GDP due to the output shock. And in the Hungarian context, more broadly, more than 50% of all instruments directly related to high or very high risk sectors are being held by 5 banks only. This could create cascading impacts. It may occur both to within the real economy through value chains and in the financial system through contagion risk. between financial institutions, which means that in the event of a nature shock, if a financial institution has a large portion of its portfolio concentrated in a particular sector that experiences a shutdown or a downturn, such as in agriculture, the institution overall financial health could be impacted. And just for a conclusion, as a last slide, I also brought you the supervisory considerations. So this is really based on the pillars of making recommendations for MMB's Green Program, which has 3 pillars: initiatives to the financial sector, developing our social and international relations, and the third is greening our own operations. And so always see these recommendations on the short, medium, and long term relates to, and how it relates to next steps for us on nature-related risks based on all of these assessments. And then this project, first of all, on the short term, is to leverage existing resources and methodologies and engage with international efforts, such as at COP16, where we have actually been and successfully participated, also did similar knowledge shares like I'm doing right now. On a medium term, to start developing expectations for credit institutions and for them to refine further their approach to nature besides climate, and to develop their scenarios and integrate those into their monetary forecasting. And on the more long term, to prioritize domestic nature-related risks to ensure meeting their objectives in the long term and consider adjustments to their existing frameworks. So just in a conclusion, I'd summarize by saying that our project found that the erosion of natural capital linked with biodiversity loss and environmental degradation generates significant and long-term risks to both society and the economy, and therefore financial institutions. And that's what really our project proved. So with that, I'll conclude, and thank you for your attention.
Thank you so much, Kata. There's some really bracing statistics in there in terms of implications of nature degradation for the economy and financial risk. So I encourage everybody to read the paper. We're going to share a link in the chat. And maybe we can also share the presentation with some of those statistics. With that, we're going to shift over to our last case study here with Dr. Nicola Ranger, who's going to talk about advancements in nature-related risk assessment in the context of the UK, so EU plus geography. So over to you, Nicola.
Thank you so much, and thank you so much for the invitation to be part of this event. If you could jump to the next slide, please. So I'm going to talk about the work that we did in the UK, which actually was based on a collaboration with the NGFS the year before. I'm going to slightly shift around from a normal presentation and really try to focus more on the methodologies, because the topic of this webinar is really around those advancements in nature-related financial risk assessment. So I'm going to sort of talk you through the results, but I'm going to then very quickly get into thinking about what are the key advancements that have already been achieved through the work that we did on both risk assessment and scenario development, but then also talk through some of the next steps. And I should say as well, this is a really great area to be part of, and it's really fabulous to see these advancements both from ECB, PIC, NatureFinance, and the Hungarian Central Bank. So it's a real pleasure to be part of this today. So if we can go to the next slide, please, and then jump to the next one. So firstly, let me just talk briefly about the results of the study before I go into the details. And so to set some of the context for this work, so we were requested by UK government, so by Treasury and our financial regulator in the UK to look at what is the financial materiality of nature-related risks for the UK, but also recognizing that the UK is a very interconnected economy, and therefore actually this analysis is global, and I'll talk you through some of those results. To do this work, we worked in collaboration with a number of partners, the Green Finance Institute, Reading University, UNEP WCMC, and also NISA. So what we found then, so our first task was to answer that question, which very much came from Treasury in the UK. Are these risks macrocritical for the UK? And what we found is yes, they are. So we particularly looked at 3 scenarios, and I'll talk through the method in a moment, that looked at particularly a sort of an acute shock scenario, but also a chronic scenario. And we looked at 3 different types of nature-related risks in this part of the analysis. So one was a health-related risk. So in this analysis, we really tried to look at a very broad range of risks. So what are the health-related risks linked to antimicrobial resistance and environmental damage? What are the international supply chain risks associated with environmental damage globally? And then what are the domestic risks from environmental degradation within the UK? And I say actually the UK is one of the most nature degraded countries in the world, sadly for us who live here. And what we found is that those impacts in the short term could be anywhere between about 6 and 12% of UK GDP as an acute shock. And what was really important about this study is that we then also combined it with climate change, which is the figure at the bottom there. And what we could see is that actually these nature-related risks are compounding with climate-related risks and can almost sort of double or more the nature-related risks, the climate-related risk that we would expect, for example, from the NGFS scenarios. So if we go to the next slide then. So that was the result on the macroeconomic side, but we also did one of the first nature financial stress test, which is sort of similar to what you've seen here from colleagues from Hungary, and actually sort of similar scales as well. So we looked at our 7 largest banks in the UK and looked at a financial stress test of nature-related risks. And we looked across a very wide range of ecosystem services, so more than 20 different ecosystem services, everything from water to looking at soil erosion, to looking at pollination risk, 23 different ecosystem services, and then a financial stress test. And what we found is, quite material reductions in loan values possible within the next 5 years or so. And we really tried to take that very short-term perspective to match that focus of financial institutions on sort of risks over the next 5 years. And we particularly found that banks that are very exposed to the agricultural sector, as you might expect, tend to have the highest risks. So actually we saw potential adjustments in loan values up to around almost 10%. But actually there were some other sectors that are at risk as well that you might not expect. So things like utilities, which are very dependent on water. So again, we found that materiality. And I should say, as the big caveat at the top, that these numbers have been estimated quite conservatively. So do see them very much as a lower bound, and we're working to make them more comprehensive now. If you go to the next slide, please. So the other key result that we found, so one of the big challenges that we needed to address for the UK, which is also relevant, obviously, for the rest of Europe, is that our economy is so interconnected. So we had to look at the global supply chain risks as well, and also our the global dependencies of our financial sector through its global lending activities and investment activities. We tried to capture all of that in this study and we could analyze for all of these different 7 banks where the risk is coming from in the world. And you can see that in these diagrams here, which are a bit too small for you to see the numbers, but green in these bars is basically the risk to the 7 banks coming from the UK. And the other colors there are from other countries. And you can see, for example, the US and a number of European economies come up as particular sources of risk to the UK. And overall, we found that these international risks account for more than half of all of the nature-related financial risks faced by the UK economy. So that's a really important message for doing this type of assessment. We cannot ignore those international supply chain risks and financial contagion risk globally as well. If you go to the next slide, please. So now I'm going to sort of just briefly go into a little bit more of the methodology that underpinned all this. And we were trying in this study to overcome a number of challenges. So one is, obviously, we wanted to put nature in terms that financial institutions could understand. So we looked at sort of key macroeconomic variables, but also a variable which we called the NVAR, nature-related value at risk, which is sort of similar to the definition of VAR used by financial institutions. We also we wanted to look to other studies, particularly those we've just seen, have done a really sort of deep dive assessment on a particular ecosystem service or particular sector. We wanted something that was more of a sort of broad and shallow approach. So looking across every sector, across every ecosystem service, to provide that sort of quite comprehensive view of risk. So it's a slightly different type of methodology that tries to take a very comprehensive approach to doing that. Then we also wanted to tackle this challenge of the cascading and compounding aspects. We wanted to really think about how can we develop a modeling approach which allows us to capture these very complex risks. And to do that, we combined a sort of narrative scenario approach with a quantitative scenario approach. And I think this approach has a lot of resonance as well for broader climate stress testing, given the need to capture those complex risks. So I'll briefly just talk about those two innovations now, but also just to say a starting point to all of this was to do a very sort of broad assessment of nature-related financial risk to the UK. And we did that based firstly on expert consultation. So we consulted with scientists, with financial sector specialists, with others, and did a sort of impact versus likelihood assessment of all the ways that nature could impact on the UK economy. And the reason we did that was to make sure that our quantification exercises were comprehensive enough to calculate and targeted enough to assess the right risks for the UK. So I would definitely recommend that as an important starting point to this sort of assessment. If you go to the next slide, please. So the first part that we looked at was how to assess value at risk. And what we wanted to do there, so we do use the Encore approach, which tells you about dependencies of different sectors, but we coupled that with other data as well, because the dependencies don't really tell you much about risk. You can see a big dependency, but how does that impact on the balance sheet of a financial institution? That's quite a different calculation. So to do that, we combined information on the state of the ecosystem services around the world. So this was a global analysis that we initially did with the NGFS, and then coupled that with a supply chain approach using Exiobase, information on the vulnerability of different countries to these risks, and also then on the sensitivity of different sectors, so the potential volatility in different sectors to these types of risks. So imagine it as a sort of stepwise process of which the Encore is one part, but is one of about 5 different steps. If you go to the next slide, please. So then how we address the scenario-based approach. So the key, as I said before, piece here was, how do we look at an approach that can actually capture these complex cascading risks? Because it's really important to note that a lot of nature-related risks, there will be direct risks to particular firms that will exist. So for example, impacts on flood risk from changes in land surface, or impacts of pollinators on a particular farm output, for example. So that will exist. But actually what we found is that the biggest risks are these cascading risks, these sort of globally interconnected risks. And so we needed to come up with an approach to allow us to assess this. And what we did was sort of try to combine very sort of precise quantification using integrated assessment models with the comprehensiveness and robustness that you get from more narrative scenarios. And so what we did is, based on our understanding of the risks, we assess we look at developing a whole range of scenarios to test those different types of risks. And then we prune that down to identify the most relevant scenarios for the UK context here. So which are those ones that really allow us to test the different space of possible outcomes and the different types of risk? And then we've then developed a narrative scenario, very detailed narrative scenario. And then finally, we put where we can quantify that, we put that through a model, but use different types of quantification. If you go to the next slide. Yeah, and this shows the results we see. So what we do, this is an example for the international scenario. We do all this complex sort of mapping out the different transmission channels, and then look at estimating where we can the impacts on GDP and other macroeconomic variables. And actually, this is a result that's never been seen before, which is the GDP impacts for around 40 different countries, including a number of European economies. And you can actually see there quite significant variation in the GDP impacts. So where we're going next, just briefly as I finish on this now, is we're doing based on feedback from this work, we're doing a lot of work to improve the granularity of this assessment. So we're working now with the European Space Agency to look at how we can bring in more satellite data and more asset level data to really get down to the kind of corporate level assessment that financial institutions and corporates need. So that's a big focus for us. As part of the EU Horizon project, we'll be working to bring in more information about the opportunities side as well and the transition risk. We're using AI to look at sort of corporate action and also looking at the impact side more. And this is some new work that we've been doing, looking at actually expanding this analysis geographically across all of the major banks in the world, and also looking at the fiscal side of this as well. And you can see the top there showing the impact of nature on sovereign credit ratings. So this is just a taste of some of the things we have to come in the next few months. Thank you.
Thank you so much, Nicola. Wonderful. So we are right at 9 o'clock. Technically, we're supposed to take a break, but I would love to take 5 to 7 minutes. We'll still give people a chance to stretch before the next session, just to give presenters a chance to respond to some questions here. So there's some very technical questions in the chat that I'm going to leave to presenters to answer in the chat, but all of them in one way or another seem to me to be fundamentally asking whether, based on the current state of data and key assumptions, these scenarios are overestimating or underestimating the risks and implications for financial stability of integrating climate and nature here. So Nicola, you just did this at the end of your presentation, but I want to give in particular Miodrag and Kata a chance to just make any caveats on this front about where you think additional research and data could improve the accuracy of the scenarios that you presented, whether the results that you presented here are likely, in your best expert view, to be under or overestimating risks and impacts on the financial system and economy, and sort of where you'd like to head next. So maybe I'll just turn to both of you if you have anything to say on those fronts.
Thanks, Julie.
Miodrag, I see your face. Yeah, why don't you go first?
I'll start. Thanks a lot. Yeah, I've highlighted this point actually as one of the most important lessons learned here, that we are potentially underestimating the risks, both physical, economic risks, but mainly economic risks, especially in our business as usual scenario, the created world scenario, while we are assessing the degradation of nature and the environmental damage to a great detail, we are missing this feedback loop from degraded nature to the agricultural production, where we see the economic damage. And I think this is the key area to work in the future, to basically exemplify the need more that this current practice is also economically unsustainable, not only for the environment, but also for the economies. That is one of the links. Of course, there are many other links that are still missing between this complex interconnectedness between climate, nature, and agriculture. And I'm sure there will be much more work to be done in this aspect across the entire scientific community.
Thank you so much. And just to note, is it accurate that the scenarios work that just came out also doesn't currently include the impacts of extreme weather events, which one would also imagine means that we're probably under rather than overestimating the potential impacts here?
Right. So while we are including climate change impacts on average globally on the levels of crop yields, for example, or water availability or terrestrial carbon stocks, these extreme events are much more difficult to model and project in the future. So this is something that could be maybe done on an individual basis or a scenario narrative basis. So we can maybe try to simulate a narrative where we wipe off the entire Amazon or another tipping point for the system, but this could be only for the how can I say, for the diagnostic assessment. What would have happened if this tipping point would occur, but we don't actually know at which stage this occurs in the future.
Got it. And just to note, Nicola is pointing out that there are 3 scenarios do include extreme weather events, so that's helpful context. Kata, anything that you want to add on this topic before we close out?
Yeah, maybe I would just add the fact that refining the scenarios through more location-based data or expanding the risk radar from physical water risks that I explained are part of the drought scenario to other types of risks, not just physical risks, but regulatory risks, for example, could also refine the assessment. But for us, we are not a research institute, so it's already a great deal of thing to develop a project like this, and this just concluded really. So we are looking into the next steps and how we could truly develop a strategy to integrate biodiversity related, nature related financial risks and the results of this fantastic research project into our mandate, into our green program, into our green recommendations that we already have for credit institutions and insurance. And I would also just mention the green preferential capital requirement program that is a quite unique central bank a tool, you know. So I think the implementing already these findings is a key next step for us, but obviously looking into the refining the stress testing, which we already have for a couple of years now on the climate side. So there's a lot to do here. That's just what I would add.
That's great. And that's a great segue to the next section where we're going to sort of look forward to implications and next steps with our panel. So welcome back to part 2, the home stretch of this webinar and developments around nature, climate risk scenarios for financial decision making. We had a really rich set of presentations and a brief discussion during part 1 that has hopefully given us a better sense of the current state of the art when it comes to efforts by central banks and academia to understand and engage with nature and climate related financial risk in an increasingly integrated and sophisticated way. So now we would like to spend some time with our esteemed panel of experts talking through where we go from here. So what's next in the realm of scenario development, risk assessment and monitoring, policymaking imperatives? What are the key limitations and barriers preventing all of the insights we just heard from translating into action amongst central banks and financial supervisors? And how do we see this growing attention to nature climate integrated risk trickling down to private financial institutions, for example? So we're going to dive right in the interest of time with the first round of questions for our panelists, starting with Irene at the ECB. And Irene, I'd like to ask you, just to kick us off, what do you think what role do you think central banks should play in shaping the financial system to address these combined risks of climate change and biodiversity loss? And what kinds of collaboration with other stakeholders in the financial system do you think are needed to fulfill this role?
I hope you can hear me, Julie. Yes, okay, great.
Great.
Thanks so much for organizing this jointly with us. I think this is a great already, if you refer to collaboration, this is a great example, I think already, also together with the work we've done with PIC and the other university to really see that we can do this together. I won't repeat because I think this has been really well set out by other presenters, that why nature-related risks are important for central banks and the economy and the financial system at large, because it impacts prices, inflation, and it leads to financial risk. So that's why we should care. And I want to also start with like one short reference, because sometimes I get asked a question, oh, is it really happening? Is it real? Well, should we care? I don't know if anyone read the FT article yesterday, because there was a nice article that coffee futures hit 47-year high. So really the prices of coffee really skyrocketed. And why? Because there was a physical risk and a transition risk that is already materializing today. So hot and dry weather followed by heavy rain in Brazil, and 3 consecutive years of poor weather in Vietnam has stoked concerns that supply of coffee beans will drop. So that's the physical side. the transition risk side, there's EU legislation that will require European importers to prove that coffee or any product they import into Europe is not grown on deforested land. So this apparently also rushed coffee importers to buying beans already today. So I think this is just a good example, like on how this, like the impact of climate change is happening, and it affects also coffee beans, and coffee beans are also really affected by if land is available, fertile land. So also the connection with climate change, I think, is a very good example of what's happening now. So that means that if you're like your coffee in the morning, you'll have to pay more. And let's also think about the impact of the farmers and the financial risk it causes there. So this is just a very concrete example. At the ECB, I don't think it's been highlighted so much. We did this research last year on the dependencies of 4.2 million companies on ecosystem services, and we found out that over 70% is highly dependent on at least one ecosystem service. And we looked into the investments of banks into those firms, and over 70% of banks' loans are invested in firms that are highly dependent on ecosystem services. So this just shows how this is so connected, and if the ecosystem is degrading, it will lead to higher risks and higher and price impacts in the end. And also the European Insurance and Occupational Pension Authority, EIOPA, they also reported approximately 30% of insurance investments are critically dependent on nature and the ecosystem service it provides. So you see all these examples on top of what we've already heard. I think these are just very important work that has already been done to show the dependencies and show the potential of risk, since we know that nature is heavily degrading at a fast pace. Bringing it now to us, like, what is it? What is our role? What is central bank's role? What can we do? Well, I think a lot of speakers also referred, like, of course, governments are first and foremost in place to set out clear transition pathways and preserve nature and put legislation in place. But to do our job well, we have to make sure that, like, for supervision, we need to know that banks manage it. For the financial stability implications, what's coming from it, and also the price stability implications. So we really need to better understand on how the whole transmission channels go from nature till in the end price stability or financial risk, and in a way doing our job well. But I think on top of that, we have a very important other role, because we have this unique, central banks have this unique macroeconomic perspective. So they can signal the macroeconomic developments and also raise the awareness of the value of nature for the economy at large. I think that's a very important other role we can play by telling our the findings we have to key stakeholders that need to take action in the end and raise the awareness. Your last question more is like on collaboration. I think this is already one point, like, that we share what we find and we make sure that people are well informed based on good data, that they can take action. But on collaboration, I think I see different levels, and we've been talking a little bit about the network for greening the financial system, but this is, of course, the platform I see worldwide where all central banks and supervisors work together to better address nature-related risk. Sjoerd, who also in the panel, probably talks about that more because he's very involved in that work. But I think this is really a great example of where collaboration sits. And then I think that the work that was presented today, this interdisciplinary approach with you, with Minnesota, with Dick, I think that's a way as well that we can see this wider community collaboration happening. So that is my first contributions to the panel.
Thank you so much. That's great. And that's some really bracing data and insights around nature and climate related risks and dependencies and the potential impact on really the real-time impact on prices and potentially financial stability as well. So I'm going to turn on that front to Sjoerd and ask you, based on your work in the DNB and with the NGFS, the Network on Greening the Financial System more broadly, what lessons do you think that central banks can, should, are hopefully taking from increasingly integrated assessments of nature and climate risk? And what role do you potentially see for NGFS going forward in terms of advancing regulation and insights in this field, building on a lot of great research and publications that you guys have already done?
Thanks. Yeah, a very good question. So maybe to illustrate, so where I'm coming from, I'm responsible for integrating nature in the work of DNB as lead nature. And within the NGFS task force, a few things that I do is I led the team that produced the conceptual framework and is now responsible for a team that integrates nature in the wider work streams of the NGFS. So my focus is really on how to mainstream the consideration of nature. That is where I'm coming from. I think that what can we learn from climate? The few lessons. I think first of all, the observation that climate is part of nature is critical here. So in a way, you could say that we've already been integrating nature in financial risk management, just with a very narrow lens. The question now is, how do we broaden it? And I think one element there is that I think the lesson we can learn is that a lot of the conceptual thinking around climate really helps to advance nature work. So even simple things like the physical and transition risk narrative, it provides a stepping stone to build on and improve nature with a slightly higher pace. Internally, I sometimes also use it as a benchmark to ask myself, so, hey, this is something we do for climate. Shouldn't we also do this for broader nature-related considerations? Now, the answer might be no, and the answer might be more is needed because climate isn't the same as the other dimension of nature, but I think it's an important start. So that is more on the conceptual level. I think on the quantitative level, I think there we have some practice already with working with imperfect data. And I think today is a perfect example of this. This month, the new set of long-term climate scenarios was released by the NGFS, and it indeed showed that physical risks are now higher in the new set. And I think listening to the conversation today, a lot of the underestimation of risk could be a fear that we're not sending out the right message. And in fact, I think because we've gone through that, we know that it is important to be vocal about that and see it as an encouragement to improve. So I think that is the second lesson. And maybe the third lesson for me is the importance of narrative. And I think this is a point Nicola also touched upon in her presentation. I think for climate, the story is generally clear. Even though it's complicated, it resonates with people. And I think what people struggle with still for nature is how to make it tangible. And that is where I think we can draw some lessons from the climate work, because producing these frameworks is important, but equally important is their uptake. So what can we learn from that in terms of improving the case for nature from the narrative, even if the modeling isn't perfect yet? Now, with regard to your second question, I think on the role of the NGFS, what I see is that it sits in a perfect middle ground between the real frontier at the beginning of the S-curve, real academia, new insights, pioneering work, and standard setters. I think it's a perfect forum to bring together those insights and make it our own within this network of by now more than 140 central banks and supervisors. Now, and because we're not a standard setter, it creates a freedom to advance some of that thinking and inform the work of those standard setters going on. Now, that's not an automatic process. I think still looking at the landscape, there's still a lot of work to be done to integrate nature in the work of standard setters. But by making sort of those first strides within the NGFS, hopefully we can be of help.
Wonderful. Thank you so much. So next, I want to turn to Alexander Barkawi at CEP. Alex, you're sitting outside of the central banking system at CEP, so perhaps have even more freedom than NGFS to be a bit radical and provocative in terms of where you think this field needs to head. So I'm interested to hear from you. What are some of the key policy changes that you think central banks and financial regulators need to prioritize today to address these deeply interconnected challenges of the climate and nature crises? And then it would be great to also hear a little bit from you about how you see the trickle-down effect of some of these actions then impacting private financial institutions.
Sure. Thanks so much, Julie, and hi, everybody. I'll start off with three more general points, and then I'll address the more concrete things that I hope central banks will increasingly move ahead on. So on the more general points, first of all, I think it's critical for us to be really clear about the distinction between diagnosis and action. And the need to keep that in balance and to recognize that, yes, we need diagnosis, we need analysis, but we also need to get into action now, which is why I was so happy that the report also emphasized that while there is a lot of further research needs, central banks need to act now and not wait for the perfect data. I think this is really a critical statement from this report. And on that note, secondly, I wanted to kind of give an analogy on how central banks, in my view, need to deal with the uncertainty in a different way than what they may have been used to in terms of data perfection previously. And I thought a good analogy comes from the case of the downfall of Silicon Valley Bank in 2023, when the Federal Reserve shortly thereafter published a report on what went wrong. And I brought along a quote that I wanted to share with you from Michael Barr, who wrote the introduction, being the vice chair for supervision of the Federal Reserve, where he said the following: "We need to develop a culture that empowers supervisors to act in the face of uncertainty. In the case of Silicon Valley Bank, supervisors delayed action to gather more evidence, even as weaknesses were clear and growing. This meant that supervisors did not force SVB to fix its problems, even as those problems worsened." And I think we must be conscious that this applies just as much to the topics we're talking about here. I think we are conscious that there is a risk. We're conscious that we have data gaps, but we, I believe, need to act now. And that brings me to my third point, that while I'm saying we need to act now, I don't want to give the impression, also echoing what Irene said on the needs for other parts of government to step in, that central banks have a silver bullet. Nobody has a silver bullet on this. Nothing is a silver bullet. Carbon prices are not a silver bullet. Regulation is not a silver bullet. What I think we need are all hands on deck of every policy field to make sure they are aligned with the objectives we have and they collectively address the risks that are being described in your report and in so many others. So that's kind of the foundational aspects that I wanted to share. And with that, let me move to the very concrete 5 instruments that I hope we get more traction on among central banks. So the first one is essentially the balance sheet management of central banks. What assets do they buy and sell? The ECB, for example, has taken an important first step in that direction by starting to integrate climate risk considerations into the management of their corporate bond portfolios. The Bank of England has taken a similar step. We've seen pretty much nothing else from other central banks. And there's also still a lot to do within the ECB in this field, as well as the Bank of England, because so far only corporate bonds are being covered by this, not asset-backed securities, not covered bonds. Like, we need this to move to all other asset classes as well. And we need it to be also integrating nature risks and not just climate risks. Second instrument, very similar, is the collateral framework, which defines what assets central banks accept from commercial banks that seek liquidity from them and under which terms. And also there, it is critical for central banks to reflect climate and nature risks, both in what is called the eligibility criteria of collateral, so what do they accept, and the so-called haircuts. So what reduction in the value of an asset is applied to it, given the risks that this asset comes with. And there, as far as I'm aware, we've seen basically no step forward yet from any central bank, maybe with a very tiny exception with regard to the Bank of England and how it treats mortgage loans. So that's the second area where I would hope we see more traction. I understand the difficulties that central banks face with that, but I think these difficulties can and need to be overcome. Third point, targeted refinancing operations. So a core operation of central banks, as I alluded to earlier, is to refinance commercial banks. And they can do that in different ways. And they have in the past already said, well, we will define the universe of loans that banks can refinance with us in a somewhat restricted way. So again, in the case of the ECB with the so-called TLTROs, targeted longer-term refinancing operations, the ECB has said these will refinance loans in the real economy, excluding mortgage loans. I think there's a huge opportunity for central banks to think hard how to, once these instruments are used again, because they're not in the case of the ECB currently being used, how these instruments can be further aligned with the type of objectives that we're discussing here today. So these are the first three instruments, and they all relate to the monetary policy function of central banks, which now takes me to its supervisory function. And there, a key step, in my view, is obviously what the ECB has already done, namely to define clear expectations in terms of how banks should manage climate and environmental risks. And then building on that to say, well, those banks that don't meet these expectations need to face a response, right? And that response can be higher capital requirements, it can be penalties, but I think that's the critical next step for supervisors worldwide to take, not just to say, well, we're engaging with banks on these issues, but to say, well, if we don't like what we hear, here is the response that we ultimately need to give. Final point, the so-called macroprudential policy toolkit. So after the 2008 financial crisis, supervisors have recognized that supervising individual banks is a key pillar of financial stability, but is not enough. Because even if we supervise individual banks successfully, we can still face systemic risks due to the interlinkages between these banks. And therefore, it is critical for supervisors, policymakers to take this systemic view and deploy the toolbox they have under this title of macroprudential policy, also with regard to climate and nature risk. And I stop here. If we have time later, I'd be glad to go into more detail on these.
That's wonderful, amazingly concrete. I hope we'll have a chance at the end to circle back to some of the other colleagues here and get some of the reactions to some of the ideas you put on the table here. For now, I'm going to turn to Alexander Popp at PIC and ask you to give us some insights into what you think are some of the current gaps and limitations in the modeling that are hindering the development of these integrated scenarios, and how you think research along these lines can provide more meaningful and actionable support to central banks and policymakers today, even to Alex's point, as modeling frameworks continue to evolve, but recognizing that given the urgency here, perfect is the enemy of the good in terms of beginning to take steps.
Yeah, first of all, hello to everyone. Thanks, Julie, for the chance of speaking here. I think it's a great discussion, and I agree with many, if not everything that has been said here, but maybe giving you a bit of an angle from the modeler's perspective. And you've been asking for the gaps and the limitations of the current tools at hand, and the short response would be there are too many to name them in the 5 minutes, I would say. But it's maybe not of the biggest problem, which I want to highlight at the very end of my maybe 5 minutes. I mean, the challenge is a huge challenge in the end that we're talking about from the modeling perspective. Yeah, I mean, these are really complex problems on their own. We talk about two huge dimensions. We talk about climate and we talk about nature risk, and fair to say, also about the interaction. And I mean, if we talk about NTFS and the history of risk assessments, climate has a much longer history. And still, today, we are not capable of fully catching the issue of climate change. Extreme events have been mentioned. But what does it mean, an extreme event? For sure, you can model them, then you have the uncertainties, but then you have the interaction, especially in the agricultural sector, for example, between pests and diseases. How do they react in drought times and something like that? So it's a long cascade of uncertainties going into these assessments. I mean, that's science, and it's a complex topic, and we try to tackle it together with stakeholders like the central banks, which is very great because we can learn from each other. the question in the end is, what are the concrete gaps of modeling that we currently have at hand? I mean, the representation of the short-term shocks, and I think this is valid for all the scientific presentations that have been made today, and many of them beyond not being presented today. I mean, we don't know fully what kind of extreme events will happen in terms of climate. We don't know fully what kind of loss of services might happen and how those losses of services might interact in the future. And modeling them based on this uncertainty and the data gap that we have in terms of modeling is really an issue. Also, the interaction of the loss of nature's contribution to people. What does it mean? How does it all interact? And especially, there's a lot of interaction between climate and nature, carbon sequestration, climate affecting the carbon stocks, just to name, let's say, the tribal ones. But one of the major things is, what is a consequence of degradation in the land system? What is a consequence on agricultural yields, on carbon sequestration in the end? That's something where we really not yet have our hands on and don't have a full understanding and data availability to feed it in the models. The same holds true for the cascade that has been often mentioned here in the comments and in the presentations, the full cascade from the shocks up to the macroeconomic system. And here we talk about the macroeconomic system, but there might be other facets of human well-being, even more problematic to be represented in the modeling. So what is the consequence of the loss of those services along the whole chain to macroeconomic and other well-being indicators? I mean, it's a long list and science is at hand and tries to solve those. But the question in the end, if you talk about modeling, what is a model in the end? And what can we do, coming to your last point, Julie? How can we still, even if we have those gaps at hand and the limitations, provide central banks, policymakers, and society out there with pathways and ideas of how to include or even solve the problem? And I mean, what I want to say here, this is not only valid for the issue of informing central banks in terms of nature, in terms of climate risk, it also holds true for other assessments. Let's take the IPCC, let's take the IPBES. Even there, we have huge uncertainties and a much longer history in modeling scenarios than for NGFS or for the central banks that have been mentioned. And I think it's always bits and pieces, and also those big integrated assessment models, they are also kind of a sum of different modules. And I mean, what we can do, I would say we have two pillars in the end, how we can get into action. And the first one is short-term pillar. And that means learning from individual single studies in a kind of an assessment of what science already knows, putting the bits and pieces together in an integrative perspective, and deliver such an assessment to central banks, policymakers, and decision makers out there. The other one is, and that's a bit more of a midterm and long-term even assessment, is step by step, jointly. And that's an important part that has been already kind of mentioned in the introductory speak by Frank Alderson, that we really have to interact to learn the demands, to learn the needs, and also the interpretation of the outcomes of the current state of science assessment. And to improve it step by step, and to learn from each of the in-between steps that we currently already have at hand. We don't just simply have yet the full model that responds to all of those questions in the most sufficient order, and I'm not sure if we ever will have it in a way that we can provide all responses to the questions out there. But it's a stepwise approach. Thanks.
Thank you so much. And Justin, thank you again for joining early from Minnesota on Thanksgiving to be a part of this conversation. Maybe building on what Alexander just shared, it would be great to hear your own thoughts on what next for these scenarios. Where would you like to see them go? And what are your thoughts likewise on how researchers can make their insights actionable and timely for regulators and policymakers?
Yeah, so thank you, Julie, for inviting me to this very important conversation. I'm Justin Johnson. I'm a professor at the University of Minnesota, and my work has to date been focused very much on linking macroeconomic models with Earth systems models, in particular ecosystem service models. And so I think I provide a particularly useful angle on this question overall. So the first thing that I've been hearing, and I want to make 3 points about where I think we need to go, is we need to close the loop. Mio Drag and others mentioned that there has to date been a lot of emphasis on how economic activity affects the environment, but there's been relatively less on thinking about, okay, so once the environment has been changed, how does this feed back into changes on economic activity itself? This is really important because this feedback loop is where a lot of the systemic risk that is important to this whole discussion might really be amplified and made large. And so the basic question of how do we close this loop is partially addressed by some of the research that we're looking at in my research team. We have a model called GTAP Invest. It's similar to integrated assessment models, but it uses a general equilibrium approach. And it tries to really close this loop. And so we have a run of a very traditional economic model at the macroeconomic level, trying to project land use change and all these other things. This then gets inputted into a series of biophysical models, including ecosystem service models, which we then try to use to estimate what will be the impact, will be the shock on the economy, and use those to rerun the economic model, thereby identifying what is the impact of nature. And so it's trying to close this loop. I think that's really important. It's very new research, and so it's hard, and it's not as well established as the rest of the models and scenarios that we've been talking about in this group. So the second point I would make is that I think we actually need to integrate better with high resolution Earth systems models. A lot of the interactions that happen are going to be ones that can't be assessed at the average level, meaning you can't just say, what is the average effect of a nature to economy linkage, but instead you need to drill into the specific details. And in particular, looking at high resolution representations of the world to try to understand this. And so, for instance, I heard Nicola mention work with the European Space Agency and using their remote sensing products. I think this is a very valid and valuable direction to go. The last point I want to make, where I think we need to go to make this actionable and science-based for decision makers, is to expand our connection of our linked Earth economy models with the specific policy support models that are used by central banks or finance ministries, or et cetera. Our original work was linked to the Global Trade Analysis Project GTAP model. And this is a global model, and it has, a lot of relevance, I guess, to specific decisions that are made by specific countries. But it very quickly became evident that most of the interest from actual decision makers was to say, that's great that you did this at the global scale with a global general model, but could you do it again using our particular in-house model? And so we've had a lot of demand to do this, and we have a number of projects that have come up. We're working with the JRC, Joint Research Center in Europe, to link their Demetra model, which is a CGE model that is very relevant, but is specific to their decision context, and link that into our ecosystem service and nature impact model. We also have a country-specific engagement with the World Bank using their managed model, which is another macroeconomic model, but it's specific to individual countries that they provide technical assistance to. And the idea here is to say, let's do the same linkage, but with a model very specific to the decision context. And so the idea here is that we are going to take this linkage that closes the loop, that thinks about how the economy affects the environment and vice versa, but do it using the language used by specific decision makers. This turns out to be only a medium amount of work, because once you do it once, it's easy to spin this up with other models. And so we're already starting to get country-specific and model-specific results. And so with that, I think that just to put a conclusion on that, I think this is a great conversation to have. I think really we need to have co-evolution of both the academic methods, like I've talked about here, but then also the connection of those to the decisions being made by communities such as those represented on this call. Thank you.
Thank you so much, Justin. I'm so pleased that we have some time to have a little bit of a chat with this group before we close. And maybe just to kick off, I would love to hear thoughts from the panel, and especially to the extent that you feel comfortable, because I know these are sensitive topics, but from ECB and DNB/NGFS colleagues on some of the ideas that Alex Varkawi tabled in terms of mainstreaming nature and climate risks into balance sheet management across asset classes, in terms of looking at collateralization frameworks and targeted refinancing operations, and in terms of thinking about how to penalize or incentivize banks that aren't properly accounting for nature and climate risk in their operations along the lines that central banks are recommending. So curious if you feel these are areas that are already on the radar of your institutions. Do you see more or less potential or challenges with any of these particular ideas? Keen to hear some reactions, and others feel free to come in as well.
I can get it started, Shirt. I think if that's fine with you. Thanks for asking the question, and also thanks for all the panelists for bringing in. And I really like that that Alex and Justin are on the panel, because I think that's bringing in the modeling approach from the science is really enriching the full debate, and that is very much needed. But very, very quickly on the points raised by Alexander Varkawi, of course, I'm aware of that. So that's I think already, and we always need outside views and ideas to trigger what we can do. We have a mandate. That's the other side. We have price stability is our primary objective, and this is what we should do. And also for banks, we have to make sure that they manage risk. So to go to actions right away, I think we need to know more, and we need to have. We can't do that right away. So let's be very clear on that, and also because that's how it's guided. That's our North Star: price stability, banks managing risks. But that even shows the bigger importance to keep going on. How do we better properly price this risk? I think everybody has said, like Miodrag pointed out, the underestimation of risk. Nicola said the cascading effects. Alexander Pop just mentioned like the many uncertainties of the transmission channel and how to model that. Like all these kind of things are just very much needed to know more. And let me point out two more things that I found really important in the whole debate, and that's of course data. I think we've been mentioning that, and also the reliability and how you categorize where are the risks, what is a good investment or not. I think the entering into fourth of the Corporate Sustainability Reporting Directive in Europe helps. The work of the TNFD is also a great asset to make sure that we get the information from companies on biodiversity, nature, and all those kind of services. Then the other thing is, I think we also mentioned like what is the data of nature, and how do you and more the scientific data, like the ecosystem services, are they at risk? How do you make these scientific data of use for financial decision makers to take that into account? I think this is a very important part as well. What we also saw is that the localization of nature it's so local. So you can't go to headquarters of big companies. You need to go to their subsidiaries, and you even need to go much more granular. So I think that's around the data point. I see that there are things developing there. My second point is like regulatory clarity regulatory certainty, those are really key drivers to channel investments. So to have the example I gave on coffee in this when I started, right? Having a deforestation law or protection of deforestation law in Europe, how that affects like how investments are going, where our investments are going, and how that is preserved. I think this is something really important. But there's also debate if this is too complicated to implement and it should be postponed, all those kind of things. But to have really clear policy pathways and policy commitments there helps there. And I think by us, central banks, scientific researchers showing really the risks that come from a degrading nature and the impact it has on the economy helps hopefully governments to take bolder actions to set regulatory requirements. And one point I would really see also as an important policy avenue is really the transition plans for nature. So here we can't have the economy changing overnight because now we're maybe harming the economy, harms the nature too much, degrades it too much. You can't change it overnight, but what are the plans to better preserve it, and how do you go about with that? I think the transition plans from companies and also helps banks indeed, again, having the conversation with the companies they're investing in to better know where the risks sit and how they go forward looking. And the last point, like we really need to move globally, creating this level playing field where what Sjoerd said, that like I think today we have even 144 members of the NGFS trying to move forward with all the central banks in the world, exchanging our experience. So that's the last bit. And finally, is this topic difficult? Yes. Do we lack data? Yes. Are there many unknowns? Yes. But finally, is it important to work on this? Yes. And therefore, the best thing we can do, and that's what we're doing. We just set the first steps and take action on the basis of that. And the examples that were presented today are already great testament that a lot of things can be done. So that's my response to that. Thanks.
Thanks so much. Sjoerd, do you want to come in?
Yeah, no, I mean, I'll add my 2 cents, but keep it brief. So thanks, Irene. I think you said most things already. So I think your point around mutual learning strikes me, and I think this is something that has come out of this project, and to me, it's also something we need to probably do with the financial sector, because they're probably struggling with similar questions and issues as we are struggling with. Which is one of the reasons why at DNB we did a TNFD pilot on 2 of our own reserve portfolios, just to go to a similar learning exercise and see how we can integrate some of that in our own reserve management. And why there might, aside from supervision, because I'm not part of supervision and I certainly can't speak on behalf of all the NGFS members, but why we also pursue different routes, such as we have a sustainable finance platform in the Netherlands where we sit together with governments, with regulators, and with the financial sector to address some of these issues, where we have this working group on biodiversity. So I think aside from actions with regard to punitive measures or strict enforcement, I think these things are equally important to integrate nature in the decision making, which I think should be the end goal.
Brilliant, thank you. I wonder, Alex, if you want to come in and give any final thoughts and reflections based on those responses.
You mean Alex Bakawi?
Apologies. Yes, I do.
Okay. Yeah, very happy to. Thanks. I mean, first of all, I want to make sure I'm not misunderstood as saying, let's move directly to action without knowing anything. That's not what I'm saying. I'm saying we need a balance between diagnosis and action. And the balance needs to reflect the fact that there will always be a high degree of uncertainty. And we need to find, I think, as the report says, heuristics, how to deal with that uncertainty. And my belief is currently the balance is too much on the diagnosis side, and it can be, and it should be further to the action side. And maybe just to give a few examples, not even talking about climate, because I think on climate, we really have good data and a lot more could happen. On nature, I'm conscious the data situation is more challenging, but even there, The Banque de France, as I understand it, and Sirt, you also mentioned your own reserves portfolio. The Banque de France has started looking at biodiversity impacts in its non-monetary policy portfolios. It has a data set that it is using for that. And it has been doing so for 2 years. I would assume after 2 years, there are good insights that would help us calibrate whether that can be used in the monetary policy portfolios. Now, maybe you've done that, and maybe you're saying that data is not good enough for the monetary policy portfolios. But, you know, given the many years that the private finance community has already been on this, like, I mean, I've been taking care of the Dow Jones Sustainability Index 20 years ago, and we've had data. There is data. It might not be perfect, but it is there. And I think it's better using it than just not moving. And maybe just as a last point, also because I saw in the chat the question, what's that one recommendation that you would give on the supervisory side? I think we have a grasp of tipping points in nature. There's good research out there on finance that increases the risks of these tipping points being reached. And I could imagine that supervisors take a more forceful stance to engage banks that they supervise on whether they are funding activities that increase the risks of these tipping points being reached, and to stop doing that. So I think there's so many concrete things on the table, and we need to move ahead on this.
Thanks, Alex. I am going to give the last word to a panelist of panels past. Nicola from our first session would like to come in and make a final comment, and then I'm going to wrap us up for today.
Thank you so much, Julie. So I just want to make sort of two very quick points about some of the things that we heard from financial institutions that were trying to get their heads around this, and what we could do next to help them. And one was to talk more about the opportunity side. You know, what we heard in talking about risk to them was, you know, this is really helpful. However, what do we say to our clients? How do we engage our clients on this topic? You know, and for us as financial institutions, what products can we be offering them? So I think as well as the risk side, we need to focus also on that opportunity side more. I know that's not so much the role of central banks, but more broadly in terms of getting the financial sector on board, I think that can really help. And finally, sort of one from the central bank perspective, one of the things we learned on climate was that actually, you know, central banks just, even though we don't have the data, just through encouraging financial institutions to start thinking about this is really powerful, and we'll see their capability increase very, very rapidly. So I think we're now on the cusp and ready to be asking more from financial institutions to think about this. Thank you.
Thank you so much, Nicola, and that's a great segue to wrapping up here for today. I have to say, I'm really happy that the timing of this session turned out to be on the other side of COP29 and the US elections, because I know that there's a lot of frustration and concern coming out of both of those moments, that we're not necessarily seeing the kinds of political leadership and ambitious action that science is telling us is required to stay within safe limits of warming and avoid irreversible harm to the planet and to increasingly vulnerable communities around the world. And in that context, conversations like this give me great hope that even if we are struggling to achieve the necessary levels and urgency of leadership from politicians and multilateral agreements, we are absolutely seeing central banks and financial supervisors, or the ultimate guardians of global financial stability, really stepping up to the increasingly complex demands of their mandates and doing the hard work of trying to understand how physical and transition risks stemming from the climate and nature crisis are likely to affect our economies and financial systems in the years ahead. I think it's really clear from this conversation that central banks and financial supervisors, in close partnership and collaboration with academia, are really further ahead than many political leaders, financial institutions, and even donors in terms of recognizing the deep interlinkages between climate and nature risks, impacts, and dependencies, with the science and economic modeling increasingly backing up an integrated approach. It's also clear from this conversation that central banks and financial supervisors have a really critical role to play in the coming years in translating increasingly sophisticated insights and tools from science, technology, economic, and financial modeling into actionable real-time strategies that can, at minimum, help brace our financial system for a cascade of nature and climate-related disruption that is, as we've heard today, already starting to unfold. And best case, help our financial and economic system mitigate and hopefully avoid some of the worst case scenarios through timely and targeted intervention and oversight. I think as Frank Elderson noted at the top of this session, helping central banks and financial supervisors rise to this challenge is really going to require, and Alex Barkawi also noted this, a kind of all hands on deck approach from academia, from civil society, from donors, from central banks and supervisors, from financial institutions and enlightened political leaders, hopefully in the years to come. I think we've seen some amazing examples of that kind of collaboration today, and certainly NatureFinance for our part is really committed to being a part of this journey and supporting this agenda going forward, and really eager to connect with others in this community and figure out how we can advance this work together in the months and years ahead. In the meantime, I really want to thank all of our esteemed panelists for joining us today and being so generous with your insights with such conciseness as well as candor. I also want to thank the Children's Investment Fund Foundation for their generous financial support for the Nature Climate Integrated Scenarios work that made it possible to have that partnership with NatureFinance, PIC, and the ECB. And finally, just want to thank my colleagues, Anya Costormani-Visconti, Sarah Krish, John O'Malley, Shireen Wiseman, and my former co-CEO, Simon Zadek, for all of their contributions to this work and this webinar. So with that, exactly on the hour, thank you so much to everybody. Happy Thanksgiving to those who are celebrating, and thanks for joining.
Thanks a lot.
Thank you. Bye-bye.